And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It was the #1 topic at the recent ETF conference: what to do with client bond funds in the face of rapidly rising rates. Bond king Jeff Gundlach told the 2,000 participants he's recommending a mix of commodities, cash, and long-term treasury bonds, but other ETF providers have different ideas. Let's talk with John Mayer, Chief Investment Officer of Global X ETFs, and to my old friend Todd Rosenbluth. He's the head of research at ETF Trends. John, Global X has income equity portfolios that you say can replace bonds. I know we're going to get into a lot of complicated stuff, but just as an opener, tell us what these replacements look like.
Sure. Thanks for having me on. When you look at an equity income portfolio, you're looking at a few sectors that are paying high dividends. Quality dividends, dividends that coming from covered calls, as well as just generally high dividends, not necessarily quality dividends. And then you have some preferreds. Those sectors can provide a yield that's pretty significant, somewhere in the 4 to 5% range. And that's pretty meaningful, particularly in a market where we expect long-term rates to continue to rise. And obviously, the price of your bond is going to go down. So it's a tough place to be on the fixed income side. Much better on the equity income side from our point of view.
Yeah. Now, Todd, John's got quite a list here of alternatives. Quality dividends, master limited partnerships, real estate investment trusts, covered calls, even preferreds are on this. Is there evidence that investors are buying into them? I mean, are there actually inflows into some of these ETFs that do these sort of odd corners of the market?
We're seeing that. So when we look at the data that we have at ETF Trends and ETF Database, we're seeing demand for covered call related ETFs, ETFs like JEPI, which is JP Morgan's covered call ETF. John's QYLD is popular. We're seeing some other ones that are gaining traction. We're also seeing popularity for dividend-oriented ETFs. So higher quality dividend ETFs, as well as above average yielding and lower risk dividend ETFs are gaining traction this year.
Okay, so we're getting investor interest in them. But I want John and Todd to walk through a few of these alternatives in a specific manner. But first, I want to play an excerpt from the interview I did with Jeff Gundlach at the recent ETF conference. Here's what he told the participants to do with their bond funds.
The bond market was grossly mispriced thanks to the government's manipulation, and so everything's being repriced. I've been advising 25% commodities, 25% cash, 25% stocks, and 25% long-term treasury bonds, believe it or not, because they're so ridiculously valued, but that's your deflation hedge. And so if you actually have a 60-40 portfolio, 2022 is your worst year to date ever for 60-40. But if you had the 25-25-25, you'd be far better off.
So, John, 25%, this is a pretty low weight for stocks, but you believe you have a much higher weighting in equities here. And if you're in the right equities, the key seems to be low volatility, high dividends. Why are you emphasizing these, what we call quality dividends?
Sure. First of all, some people's portfolios are constrained, so they can't necessarily go with Jeff Gundlach's suggested asset allocation. And many investors just need that yield. And the yield is coming from, like, first we can look at quality dividends. Quality dividends are an area that I believe can, at least on a relative basis, benefit in the current environment. Typically, they're more value-oriented. The companies typically have strong cash flows, high dividends, and dividends that potentially can grow. And the market is rewarding that, at least on a relative basis. And I think that's a more safe place to be than some other sectors in the broad.
Now, I want to get a little more specific. You have this breakdown of your equity portfolio here, and you specifically recommend Vanguard High Dividend Yield, VYM. It's at 16% of your portfolio, and iShares Core Dividend Growth, that's 14%. What is it about these that you think is particularly attractive?
Well, there's just a handful of high dividend paying, quality dividend paying ETFs out there. Now, with our portfolios, we take an open architecture approach. We don't only use Global X ETFs. So we believe these two ETFs have the ability, the companies within the ETF have the ability to have stable to growing dividends, and the companies have strong cash flows. So we think it makes a lot of sense for that bucket. But that's just one of 5 buckets that we have in our equity income portfolio.
Now, another interesting group here, weigh in here, Todd. Another interesting group that he's bringing up is master limited partnerships. This always shows up when people want higher yield, and yet they've had problems. Years ago, they used to sell them on the grounds that, well, if the market goes down, they own the pipelines, it won't get hurt. And we found out that wasn't true. There's also some tax issues. This gets very complicated, right, when you're dealing with something like master limited partnerships.
It does. MLPs are different than traditional energy companies. They're often not found within the broader S&P 500. So if you were to look at AMLP, which is the Alerian MLP ETF, the largest of that group, you're going to get exposure to companies that you wouldn't have traditionally within the S&P 500. Above average dividend yielding companies that have relative stability, that are going to have some bond-like characteristics, but also have that equity risk behind it.
And of course, there's always this tax question. Every time we do this, the viewers write in and say, you better tell the viewers, Bob, about what the tax structure is like. Can you explain what the difference is?
Sure. We have a couple MLP funds, MLPA, which is a C Corp. So the taxes are paid on the corporate level. So what many clients are concerned with, are they going to get a K-1? They're going to have to extend their tax returns. It's going to be an issue. It's all done on the corporate level. So that's one of the reasons that investors like the structure, the ETF structure with MLPs. Just one other comment on MLPs. MLPs are highly correlated to the movement in interest rates. So as interest rates go up, MLPs also potentially could go up. They also have some correlation to the energy market. They are seeing a pullback today because there has been a pullback in the overall energy market as well.
Yeah. Now, what's interesting when I was talking to you about this, you have exposure to many sectors of the market, but Gunlock was very big on commodity ownership directly. He was talking about 25% ownership commodities directly. I don't see any direct commodity exposure here. Is there a reason when you're dealing with this, or
Sure.
you just wanted all equities?
Well, it's all equities, but the MLPs do have some component of energy, and they are correlated to the energy market. So I'm not trying to match Gunlock's asset allocation,
Sure.
but you are getting some exposure there as well in terms of energy.
Yeah. And we're also seeing another area, Todd, is REITs here. Now, why would REITs be advantageous in a rising rate environment? So what are we getting here when you get a REIT?
With REITs, you're getting equity exposure, dividend-paying companies. It's diversified. I saw some data recently from S&P that showed the exposure differences within the industry and now the sector group of REITs over the last 20 years. It's much more growth-oriented than had been. Exposure to data center companies like American Tower with VNQ, which is the Vanguard REIT ETF. You're going to get broad exposure. You're going to get some retail REITs. You're going to get some residential REITs, but you're also going to get exposure to more of the growth-oriented companies that you find that can benefit from a strong economy through VNQ. So this is a good way, and it's actually been very popular the past month. VNQ has been seeing some strong inflows.
Yeah, and of course, REITs have been one of the better performing sectors. So investors have caught on to this, at least this idea, for months now.
So we do have exposure to REITs within some of the ETFs. We have DIV, which has a good amount of REIT exposure in it. Now, REITs can pass on higher costs of rents and whatnot, but they could be susceptible to the business cycle as well. So if there's economic slowdown, there's kind of a push and pull. So they can pass on higher costs, but if there's economic slowdown, perhaps people are renting less. Perhaps people are renting stores much less, or offices are being rented less. So there is some exposure, but very high yields, and there is inclusion in the portfolio.
Now, I want to give another alternative, and I know we're throwing out a lot of ideas here, but that's the way it's evolving, and we're going to try to sort it out at the end here. But covered calls is another area that gets very tricky. Now, explain covered calls and how this can help in a rising rate environment.
Sure. We have several covered call funds. One is QYLD. It's our biggest fund. It's about $7 billion in assets. It has a yield of approximately 12%, very high yield. What does it do? The underlying components are the NASDAQ 100. And what we do is we write at-the-money index options on the underlying portfolio. Now, when volatility...
Writing means selling, essentially.
Yes, and then the fund
getting income.
Is getting income, and we're passing on that income to the shareholder. Now, you're somewhat cushioned on the downside, depending on the volatility in the market. There's been some volatility in the market, so it does better than the overall market in this environment, but you're capped on the upside.
But right, selling a call obviously implies that you don't believe it's going to go higher than where it is right now.
Right. The
S&P, or the NASDAQ 100.
You're making a trade-off. You're getting that income, and you're trading your upside for that income. A range-bound market is really the best market for a covered call fund. We have covered call funds on the NASDAQ, the S&P 500, the Russell 2000. So we think it makes a lot of sense if you believe the market's going to be range-bound and you're looking for that very high income.
And this has been one of the more popular areas within the ETF space, QYLD being among them. But this shows the benefits of the ETF structure. To buy individual companies and then sell calls as an individual investor, and to do that on an ongoing basis.
Enormously complicated.
Extremely complicated, but with QYLD, with JEPI, which is JP Morgan's product, with DIVO, which is an Amplify product, these covered call-related ETFs getting a lot of traction. We're finding a lot of interest with our client base as well.
But it's not free. You're paying for this service to do. What's the cost of QYLD?
It's approximately 60 or so basis points. But you're still getting that very high income. Everything is being done for you in the structure.
Right, and you mentioned 12%, right?
Right now, yes, because the volatility is a little higher, so you're receiving higher income because of the volatility is related to the
sell
options.
that call, you can charge
you get
premium,
more money,
essentially. Yeah, at that point. I mean, the average viewer just hearing 12%. Wow, like sign me up for that one. And so, but what's the risks? That doesn't mean you're going to get 12% going forward.
No, you look at it from a total return perspective. So the upside is capped because you're selling your upside and receiving something for that upside. Now, the downside is somewhat cushioned. So if the S&P is down, say, 20%, this is down right now about half as much as the NASDAQ, about half as much as the NASDAQ because we have elevated volatility. Now, potentially, if volatility is lower, you can get a little more downside.
Yeah, potentially. Todd, preferred equities are also getting a lot of attention. What is the concept behind preferreds, and why might that be more interesting than owning common stock?
So preferred, you get some of the benefits through owning common stock and some of the benefits of owning fixed income. So you're getting income, you're higher up in the capital structure as a result of it. These primarily are financial institutions. So there is some sensitivity to the economy, some sensitivity to it. We're showing some of the Global X products on the screen here. John can talk more about those products, but there's a number of products that are out there. iShares has PFF, which is another one of the products that are out there. These are also gaining as an alternative. You get some of the stock upside that you would get.
And you get a higher yield.
You get a higher yield than you would from the bonds as well.
And yet, John, it doesn't mean you're going to outperform. PFFD has not been an outperformer this year, particularly.
No, you have to think about
I'm talking about your preferred ETF there.
It's not just ours; it's all the preferred space.
Yeah.
And if you look at what preferreds are, they're long duration instruments. So if rates go up, the long end of the curve goes up. Inevitably, these are going to go down in price. But the underlying credits are strong. 70% of the preferred market are financials. Even during the financial crisis, there was no defaults. Some preferred stopped dividends for a period of time, then restarted. But the underlying credits are very good. But another way to play it is variable rate preferreds. We have a fund called PFFV, where it's shorter duration than perpetual preferreds. And while it's still down, it's not down as much as PFFD. But if you're looking at Gundlach's asset allocation, he's saying 25% long treasuries. In that scenario, preferreds would do very well.
Yeah. It's a little bit difficult to sort this all out, but I want to just chat a little bit about your broad sector. So remember, you have an equity portfolio that is an alternative to bonds, and you've got several big sector-specific bets here. Vanguard Technology, 12%, healthcare, 9%. Communication services, 3%, and even your infrastructure, PAVE, which you own, which is an infrastructure play as well here. This is a pretty broad portfolio that you've got here, suggested, and I'm not sure I would call this defensive. I mean, you've got a fairly significant weight in technology, for example. So explain this, and where does that fit in with this concept of what you're talking about as an alternative to bonds?
Got it. So when I was constructing this portfolio, I took it as a complete portfolio. Now, when you're looking at income, equity income, it's confined to a few sectors, whether it be utilities and REITs and mortgage-backed securities. And so if I wanted to build a complete portfolio, I wanted to add back a bucket that would correct for what you're missing in other portions of your portfolio. So whether it be technology or industrials or materials or healthcare, I felt like these were necessary components to put into your broad portfolio. Now, on a portfolio level, you're still getting about a 4.5% yield. But if you want to buy this as a complete solution, in certain market environments, if you're just exposed to equity income, you're at a disadvantage. And this provides a more rounded portfolio. And that
so
was the
you're trying to say essentially this is a complete portfolio in a certain way for an income investor. You're going to get higher income than if you would have just owned the S&P 500, for example.
This is totally a complete portfolio. It's a more defensive portfolio. If you actually look at the performance, it's down about 3 or 4% relative to the S&P 500, relative to the NASDAQ, and you're still getting that 4.5% yield. So it's
right. And the S&P is what, 1.5% right now?
Yeah.
Right.
Yeah. So your 4.5 versus 1.5 is kind of more defensive portfolio. That makes a lot of sense to me. I'll tell you the problem I have, other than buying this as a pack. By the way, can you buy this
Yes.
actually a complete package, the equity portfolio?
Yes, the Global X Equity Income Portfolio. It's available on InvestNet. It's available on TD Model Marketplace, Geo Wealth, Orion.
So if you just Google Global X Equity Portfolio.
Yeah, on our website, Global X,
Okay.
it's model portfolios at the top.
Okay. People want more information, can get it there. I'll tell you the problem I have. I've been doing this for 32 years with CNBC, and I always pity the viewer who's trying to understand this. This is an awful lot of stuff to throw at the average investor. All they know is they're getting their quarterly statements, and their bond funds are down, and their stock funds are down, and they're going, what the, what am I going to do here? So we've discussed today quality dividends, master limited partnerships, REITs, covered calls, preferred. This is a lot to throw at the average investor. Todd, can you make sense of this for us? I mean, is the answer to try to consider just buying a portfolio like they have and all wrapped up in a nice, neat little bow? How should investors look at all of these choices? It's a little confusing.
It is confusing, and John can confirm this or not, but I don't think people should swap out their entire 40% of their fixed income portfolio into something that's equity income oriented, because then you're taking on so much more risk. So yes, you get some of that interest rate sensitivity, yes, you get some of that credit risk, but there is more downside in investing in stocks typically than investing in a bond portfolio. So you want to make sure that you understand each of these individual components, what you're getting, what you're not getting, and look at the individual ETFs, then do your homework on that to make sure you understand what risk you're taking on, what that reward potential is, and the differences between a preferred and a covered call and an MLP and a dividend strategy. There are notable differences within those 4 categories that we're talking about.
Yeah, and I think you're probably not recommending also that you swap out your 40% in bonds necessarily with this whole portfolio.
I mean, you have to think about what I do. I manage model portfolios. I did that when I was at Merrill Lynch for a long time. I do that at Global X. So I build complete solutions. You could argue this is a complete solution, or it could be a sleeve.
But this could not just replace the 40. Could replace your whole thing.
In the current environment, it could replace your whole thing. In different environments.
The yield right now on this portfolio that we just talked about, with all of this stuff in it, is 4.5% right now.
Yeah, I think it's slightly below 4.5%.
4.5, and the S&P is 1.5,
yes.
right? So you're getting 3 percentage points right there. Would you not agree, though, Todd, that all of this is nice, but if we actually go into a real slowdown, let's avoid using the recession word, the R word, but if we really go to a very serious slowdown, all of this stuff drops. It doesn't matter. It's like 2000 again, where essentially everything. It's very hard to hide.
Exactly. So if you're looking to hide, you can look at ultra short oriented fixed income ETFs. Those are cash like with a little bit of income. And various providers offer those. You can have short-term corporate bond products. The equity exposure is a risk, and investors need to make sure they understand what risk they're taking on.
John, before I let you go, your social media ETF, SOCL, has a very significant holding in Twitter. It's 7% of the fund's assets. There's reports surfacing that Mr. Musk is in very serious negotiations with Twitter.
Yep.
They may be able to make a deal. They may not. But what's your thoughts on that as a significant shareholder in Twitter?
Well, it has about a 7% allocation. And if Elon Musk takes it out at a higher price, it only benefits the shareholder. And then Twitter gets removed from the portfolio once the acquisition is complete. So from a portfolio level, from a shareholder point of view, it's a positive.
Yeah. For SOCL, if Twitter gets taken out or taken private, you have to decide what replaces that, right?
Well, it doesn't it gets rebalanced in terms of weightings, but it doesn't get directly replaced. There will be new social media companies that come into the portfolio and go out of the portfolio based on the index methodology. So that just happens as a natural course of events.
Okay, gentlemen, thank you very much for joining us. And that does it for this week's ETF Edge. I know we threw a lot at you, but that's what the show does. My thanks to John and Todd. We've asked Todd to stick around for the ETF Edge podcast and fill us in on what happened at the ETF conference and where he sees flows for the rest of the year. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.